Good morning and welcome to this Wednesday, March 16th, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, had a big rally yesterday. It's options expiration week. Been a lot of selling going on. All of a sudden, futures jumping this morning. Haven't been able to catch a bid for a little while, and now here in just a couple of days, we've seen a pretty big rally off the low. Not shocking. We're going to talk a lot about that this morning. Currently, we do have futures up. Dow futures up a little over 300 points. S&P 500 futures over 40. NASDAQ futures up about 200. So looks like a continuation of what we saw yesterday, but I would be very careful. Today is Fed Day. If you don't know what that means, well, Fed's meeting. They started their meeting yesterday. Their second day is today. They'll have their policy decision out at 2 p.m. today. It's widely expected they are going to raise rates for the first time since 2018 in order to combat inflation. But they've got other problems out there besides inflation. I think the global markets are pricing in a recession. In our daily market report yesterday, I actually showed a chart of the Hang Seng index, which shows that not only has the Hang Seng been in a bear market, well over 20% down for quite a while now, or over quite a while. The Hang Seng just in the last month has been down 20%. It's the largest 4-week rate of change on the Hang Seng index in the last decade. The largest rate of change to the downside, down almost 20%. It was worse than the 4 months, or excuse me, it was worse than the 4 weeks after the pandemic started. So think about that. That's how quickly things have deteriorated there. So I think recession's being priced in everywhere. Anyhow, let's go ahead and get this thing started. We got a lot to talk about. For those of you who are new to Earnings Beats, you can go over to earningsbeats.com and scroll down, sign up for our EB Digest newsletter. This is a free newsletter. No credit card required. You can unsubscribe at any time. Simply type in your name, email address, hit that subscribe button. We'll make sure we get it sent out to you. It's a 3 times a week newsletter, Monday, Wednesday, Friday. Very quick read, couple paragraphs and a chart. Hopefully, provide not only some education, maybe some trading ideas if you're interested in trading. Just keep in mind any of the risks of trading any of these stocks is yours. We have no idea what everyone's financial position is and what your trading objectives are. And so it's very difficult to put out one stock or one index or one chart that's perfect for everyone. So you have to make your own decisions. But I think that the newsletter itself is very educational. At least that's what we strive to do. We strive to educate. And so we'd love to have you. Also, we do a lot of free events from time to time. We got one coming up next week. You're going to hear more about it here very shortly. But anyone who is on our Earnings Beats Digest newsletter, the list, will be invited and get room instructions. So that's another reason for being a member, being a subscriber of our EB Digest, is you are invited to our free events. It's going to be a good one too, but more on that later. All right, let's take a look at what happened on Tuesday. The Dow Jones Industrial Average, all of a sudden up 600 points. Back up to test the 20-day EMA, 33,623. We finished at 33,544. So worth in 80 points. And with futures this morning, we're going to gap up above the 20-day today. Does it hold after the Fed meets at 2 o'clock? That's a great question. I mean, there's already been a big run off the recent low. I'm going to talk about Max Payne in just a few minutes. S&P 500 up 89 points, up more than 2%. NASDAQ, big winner, up nearly 3%, up 367 points. Still, though, over 300, close to 400 points to go to get to the 20-day EMA. Futures up a couple hundred this morning. That'll help. So we'll see whether or not we can get a 20-day test. Maybe we go through it temporarily. I don't know. Honestly, I don't know. When this week, it could be fireworks. I mean fireworks. If you get nauseated by these moves back and forth in the whipsaw action, you might want to be on the sidelines. I'd like to say the market's bottomed and we're just going to go straight back up. Don't think we're there yet. So, these moves to the upside, a lot of times from an emotional standpoint, you start thinking, oh, the bottom's in. Here we go. We're going back up. Let me jump in. Next thing you know, you're back at new lows and you got some big losses on your hand. So just, I can't say what the right risk is for everybody. Just know that the potential for some serious back and forth, big numbers back and forth, that potential right now is very high, given Max Payne, given what I think is a recession, given the Fed, given what's going on in Russia and Ukraine. I mean, it's a mess right now. Oil prices, they're all over the place. We never quite know what to expect there. Oil prices, by the way, are back up a little bit today, a little over a buck a gallon, or buck a gallon. It seems like it's a buck a gallon, right? A little over $1 a barrel. The 10-year Treasury yield, by the way, right now, and I'll show you a chart on this in just a second, up another 2 basis points this morning, 2.18. Retail sales came out not so great. Again, we'll look at that in just a second. Mid caps and small caps both up more than 1%. Mid caps about 1.5%, but notice they're both beneath the 20-day. So none of our major indices on all that strength yesterday, none of them closed above the 20-day. So we haven't even gotten a short-term bullish signal from a trending standpoint. We'll get that probably at the open today, and then we'll see what we do with it. And also remembering, of course, the Fed will be out at 2 p.m. Technology, the big leader yesterday, up 3.3%. Discretionary, 3.3%. Staples, 2.25%. Healthcare, 2%. The loser, energy, down 3.66%. Now, this to me is like, if I had a picture, and I wanted the poster child of Max Payne week, that is it. These 5 charts right here. Why? Because everything that's been going down heading into option expiration week was up. And the one area that's absolutely been flying to the upside is down. Now, why does that make sense, or why is that something we should be thinking about during option expiration week? Well, when an area like energy keeps going up, traders, they like to follow the crowd, options traders in particular. So when you've got energy going up, 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 you're seeing calls being bought, calls, more and more and more calls, lots of calls in the money. Well, when you're going straight up, you're not going to have a whole lot of puts in the money, because as everyone is buying puts on the way up, they're getting wiped out. Prices keep going up. So there's not much in the way of in the money puts. And so you head into option expiration week. Just a couple of days ago, the XLE was up $77, $78 near its high. Now here we are, 2 days later, 71. What do you think all those calls that were being bought on the way up now, what do you think they look like? Probably not much. Certainly not the value they had just a couple of days ago. But now we're seeing more and more of the puts coming into play. So it's this, I like to use the analogy of a seesaw, where you've got all of the value on the call side as you're going up. So all the money is on one side of the seesaw sitting on the ground on one side. And anybody who's been doing puts, their legs dangling over on the other side. Seesaw's way up in the air. Well, as prices come down, that's when you start getting more of a balance. You start seeing more money rotating into the, into the put coffers, and less money in the call coffers. And so that seesaw starts balancing. The opposite is true for areas like technology and consumer discretionary that have been going down. All the puts are in the money. The calls are not in the money. So how do you rectify that? If you're a market maker, it's market makers aren't losing. Don't get this impression that they're losing when prices are going down, because they can protect themselves. If everybody's buying puts, yes, market makers are on the other side of that. They provide liquidity. So they're actually selling the puts. But on the other side, you have to keep in mind that in the market itself, market makers can short. So they can sell the put and then short the stock, and they're protected. Just like over here, when everybody's buying calls, market makers are selling the calls, and then they can buy the stock. Have you ever heard of a covered call strategy? You buy the stock, you sell the calls, right? So market makers protect themselves. Don't feel sorry for them. They're going to do just fine. But what happens if energy, let's use this one as an example. What happens if energy goes up, 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 market makers are selling the calls. And then on the flip side, you've got, now let's say it goes up for a period of time, but let's say the market makers at some point decide that they want to, begin to drive prices back down. So they've been buying the stock while everyone's been buying calls. They buy the stock, they sell the calls. That's how they protect themselves. But let's say it gets to a point where all of a sudden the buyers kind of dry up. We start rolling over. Now, all of a sudden, market makers not only can sell their long positions, but then they can begin shorting. What happens when they short? They wipe out all the call premium. They can make money on their longs going up. They can make money on their shorts coming down, and then they wipe out call and put premium in the process. I mean, it's a win-win-win trifecta. I mean, welcome to the Kentucky Derby. That's what market makers, that's how they can make a lot of money around options expiration. They're not going to get hurt if they don't come down. If prices don't come down on the XLE, they're not in a position to lose money. It's just they can make a lot more. So if you dangle a lot of money in front of the market makers, you better at least be aware that they might snatch it. And that's what we face going into option expiration. A very bad cyclical bear market where we've been trending lower, but it's option expiration week where market makers in many instances will benefit by prices rising short term. That's the key, short term. These monthly options expire this Friday. So this isn't, I'm not saying the market's going to go up for the next 6 weeks. I'm saying the market could go up for a day or two, and it has been. Anyway, I'm going to get into all that in just a minute. Let's look at the 10-year Treasury yield. The 10-year Treasury yield, latest, I mean, we got the breakout above that 205 level. Right now, we're up near 2.18 as we head toward the Fed meeting. What is going to happen in the bond market after the Fed meets? Anyone's guess. I couldn't tell you. My guess is that eventually the recession is going to win out, which means I think yields come back down. Short term, after the Fed meets, are bond traders going to, freak out and sell, sending yields higher and higher for a short term? It's possible. Bond market's pretty smart, though. So one clue I'm going to be looking for is after the Fed meets and talks about, I'm pretty sure they're going to raise rates today. That would really be a crazy development if they didn't. But after they announce their rate hike, what do they say? Do they say that they really do continue to expect to hike rates further down the road? I don't believe that at all. But is that where they're going? Is that what they're going to say? Because if they do, maybe we see a little bit more selling in bonds and maybe the yields go a little higher. I don't know. But I believe eventually, I think this is going to be a head fake. I think the yields are going to start coming back down. And when they do, we could begin to see a bottom, or maybe we see a bottom in the relative strength between the QQQ and the SPY. The more aggressive NASDAQ stocks versus, I mean, there's a lot of aggressive stocks on the S&P 500, but in total, cumulatively, the NASDAQ is more aggressive than the S&P 500. A lot more value stocks in the S&P 500. So when rates are going up, that's bad for growth. And so that's part of the reason why the QQQ has underperformed the S&P 500 for a while now. But I think that could bottom if we start to see rates go down. So anyway, that's one to look at as we head into today and the rest of this week, really, throughout options expiration. All right. Let's see, what else do we have here? Let's talk a little bit, just briefly, about the S&P 500. I mean, here was the big rebound. We came up off of support. 4150 was pretty good support. So technically, we're just getting a bounce off support, right? If you don't know anything about options expiration, you're not thinking anything about this. You're just figuring, okay, we're just getting a bounce off support, right? Little do they know that this is really helping market makers line their pockets quite a bit. But anyhow, futures are up, so we're probably going to challenge that 20-day. Maybe we go through it at the open. We'll see whether or not we can hold it. I think 4,400 is going to be a big number. That was the recent high coming off of this low. So I think 4,400, you got to watch that area pretty closely. And then if you connect these highs coming down, that trend line, I'm not going to annotate it. I've done it plenty of times. But that trend line right now intersects right around 4,400. So as I was saying in Max Payne webinar we had last night, which, by the way, I apologize to any of our members. I had so much going on yesterday. We did move it from 4:30 to 7:30, but I literally was walking in just about the time that we had the event. And I didn't, normally I have a lot of individual stocks that you can consider to trade on the long side or the short side. Didn't really have a whole lot of that. But the theme of this particular webinar was the spider and the QQQ still had a lot of room potentially to the upside. And I'm going to explain that to you in just a minute. But anyway, here you've got the S&P 500, the trend line, that channel moving lower. The closer you get to 4,400, the riskier it is, in my opinion, to be long the market, because I think we go back lower and I'll be really surprised. I mean, maybe we get a little head fake and possibly go up to the 50-day. I just don't see it. I really don't see it. 4,400 to me is going to be a big number. I'm not even sure we get up that high. So if you're long, if you bought yesterday, in my DMR, I talked about how I'd be very careful on the short side because there's so much room to the upside right now because of Max Payne. If you decided to buy on that, I would not be opposed to be even selling in pre-market this morning and taking some of your profits. And throughout the day, if the market rallies into the Fed meeting, my goal today is I want to be 100% cash at 2 p.m. because I don't know what's going to happen. My gut feeling is that once the Fed comes out and they knee-jerk reaction, whatever happens, I think we're going to start to move lower again. So after 2 p.m., if anything, I might start to build positions in something like the QID or the SDS. One member wrote into me and said, you really need to warn everybody that, these juiced ETFs, leveraged ETFs, can be very risky to hold over time. And that is absolutely the truth. When I trade them, I trade them. I don't buy and hold them. I'm not looking for a long-term position. If I thought the market was going to go up a lot from now through a year from now, doing something like the QLD would probably make you more money. But there's some erosion that takes place. And I've written about this for many years, even before brokerages started warning folks about it. These things are based, they're priced using options and derivatives and things like that, which evaporate over time. They start to slowly evaporate over time. So you get this, you would think that a lot of these juiced ETFs 2 or 3 times, go back and just take a look, from one period to another period. If you look at a year between them and just see if X does this, does the juiced ETF really go up 3 times or 2 times, or is it a little bit less than that? Anyway, that's a whole different discussion. But I just want to let everyone know, if you're doing the leveraged ETFs, just make sure you're educated and understand that there could be some erosion. You may not get exactly what you want. And it's because of the volatility, the up and then the back down, the up and then the back down, the up and then the back down. All of that tends to erode that double and triple value over time. So just holding on to these long-term, in my opinion, is a mistake, because if you're wrong, you'll probably lose more than your percentage, that 3 times. And if you're right, you'll probably make less than so just over time just doesn't work out very well from a risk reward standpoint. All right. Just wanted to point one other thing out here on the equity only put call ratio. This is the 5-day moving average. It's starting to go back up, but we were just at the low again, and we're not even where we were back in, late January, late February. We're still working our way back up. So I think after the market moves up, potentially moves up here in the very near term, I think we roll back over. And I'm not saying market can't go higher. We could break out, maybe the bottom's in. I don't know for sure. I just believe that if we're truly going into recession and doing so with that, the Fed is going on a rate raising campaign. I think the combination of that sends us down at least one more time, but maybe I'm wrong. Maybe I'm wrong. All right. So I'm going to pull up the QQQ here for a second. I've got a spreadsheet on another computer, so I can't share the spreadsheet, but let me just go over a few numbers with you on the QQQ. We got a little bit of time, so let me annotate. Actually, let me shorten this first. We don't need a full year. Let's do a 3-month chart. And let's do, 15 extra bars. Let's see what this looks like. That's probably close enough. I don't even care about the volume. Let's get the volume off of here. We don't need the AD line. See what this looks like. Okay, this is better. All right, so let me annotate. And let me just tell you that at this low, right here on the QQQ, we were at, the QQQ went as low as $317.45. Okay. At that point in time, the value of the in the money puts versus in the money calls, the net amount, think about this seesaw. One side of the seesaw, there was, I don't know, $3 billion worth of net, or excuse me, of in the money put premium, not net. That was just put premium. There's a couple 100,000 of in the money call premium. So it netted to $2.8 billion. That's how much these contracts were worth. If we closed on Friday where we were on Monday, if we closed at that 317.45 based on all of the open contracts, puts and calls on the QQQ, market makers would have to pay out a net $2.8 billion. Now, keep in mind, they didn't lose $2.8 billion because the QQQ, they could be shorting the QQQ while everybody, they're getting, folks are buying the puts, right? So when they're buying the puts, the market makers are selling those puts if there's no buyer on the other side. If there's a buyer on the other side, there's no impact on open interest. So it's only, the open interest only reflects where you've got calls and puts being bought or sold, where market makers are stepping in. Okay. So that's where we stood at $317. When I wrote the DMR yesterday and sent it out to our members, the number on the on the QQQ was 325. It was right about here. So let me get you another arrow. So right about here is where we were when I sent out the DMR yesterday at about, I don't know, what time did I send it out? 1 o'clock, somewhere in that neighborhood. And the chart I was showing was probably 12 something. I don't know where it was, but middle of the day, we were sitting here. At that point in time, the net, now remember, this was 2.8 billion. This little move here to getting back to 325, that 2.8 billion had dropped to 2.1 billion. $700,000 of net put premium had vanished on this $8 move. When we, I looked this morning, I didn't do the close yesterday, I don't think. No, I didn't do the close yesterday. But this morning pre-market, I don't know what it is right now, but earlier when I looked before the show started, the pre-market on the QQQ was 332.90. So let's get our next, so right around 333. So something like, I don't know, somewhere in here. So from the low here, 317.45, this morning in pre-market when I looked, 332.90, that was over $15 that the Qs had moved up in one trading day plus a gap up. 5% in just a day plus a gap. Do you know where right here based on 332.90? Now, again, I don't know where we are right now, but based on 332.90, we're now down at 1.5 billion of net in the money put premium. Just this little move here. Now, what I always talk about with options expiration and max pain, I don't say the max pain point. If you want to know where we would eliminate all of this premium based on where we're sitting right now. Now, keep in mind, max pain will change over the next couple of days because there's a lot more trading of options going on. People close out options, other people open options. Then we got the market moving up and down. So it'll move, not a whole lot, but it'll come down. But right now, it is up here near $355. So, we're talking about this being max pain. This is the zero. This is where everything gets wiped out. Now, can the market makers drive prices all the way back up there? Sure, it could. I don't think it's going to. So what I always talk about with Max Pain is it's a directional clue. It's kind of like seeing a PPO and a positive divergence. I start thinking that there's a good chance we're going to reverse and start to move higher. Is it a guarantee? No. I've seen positive divergences not work, and prices keep going lower, and eventually the divergence just gets wiped out. It gets eliminated. Same thing can happen with Max Pain. We saw this last month. We had stocks like Facebook and PayPal that looked like they had to go higher. They were getting beaten up so badly, and everybody was piling into the options on the put side. They had to bounce. They didn't. They had a couple of days, went up a little bit, and then boom, right back down, new lows. I was trading them. And I think I don't remember exactly how I did. I know a couple of them I ended up definitely taking losses on. Some others I'd gotten in at a good enough time where I think I got out even or whatever. But if you didn't get in at the right time, if you got in at the high on Facebook or PayPal, after they had already bounced a little bit, they still had a lot of room to go up higher to get to Max Pain. They never went any further, turned around and went straight back down. We could see that today with the Fed. We could see the Qs get up to 332, 333, 335 intraday and have the Fed meeting come out, and that could be the top. We could see in the next few days being back down at 315 or 320 or lower. Or we could potentially see 354. I don't think we will. But that's the kind of volatility that you have to be prepared for as a trader. What are you going to do if you're getting in on the long side and the market starts to crater and go in the other direction? What are you going to do if you short? Let's say the Fed comes out and it looks like we're topping and all of a sudden we're moving down and you're like, okay, I'm jumping in the QID, the SDS, and then the market takes back off again to the upside. What are you going to do? You better have your plan in play before you take positions. Otherwise, market makers are literally going to be leading you by your nose because that's what emotion does to us. And this kind of a market's very emotional. So I'm just pointing these numbers out because as the market moves or as prices move up, market makers are making a fortune. They are printing money. Anyhow, now, and if market turns back down, market makers can short. So that's, not only is the market going down, but you could also see market makers piling on. They could go on vacation and just simply live on the short side. So they're not providing any kind of support. And that's why we see these big moves down like this. When you go down pretty fast in a big sharp line until you get capitulation. Down, capitulation. Down, capitulation. So if you start going down, don't be a hero and jump in front of that freight train. I would wait until you see one of these days that suggests that things are going to be a little bit calmer. Wait until that VIX tops back in the upper 30s or even in the 40s. Those are the things you need to be looking for. Crazy day, crazy week that we have ahead. That's all I got to say. The spider is basically the same thing, but let me just pull the numbers up. The low that we saw was 415.79 right here. This was just Monday. Yesterday, we closed 426. This morning, when I looked, we were at 430. So moving from 415 to 430, that $15 cut from 2.3 billion right here, net put premium on the spider, 2.3 billion down to a little over 1 billion. So already 1.3 billion saved. And maybe we go up a little bit more. But my point is, the closer and closer we get, the more we move toward Max Pain, the more I would be very careful on the long side. If I'm right and this market has another down leg, it could be swift. So just be ready. All right, market getting ready to open here in about 30 seconds. I don't really have a whole lot more to add. I do want to just point out a couple of stocks. Small software company, Smartsheet, reported. I think they were down just a little bit after hours, if I'm not mistaken. Yeah, they were down 2.5%. Jabil Circuit, it used to be Jabil Circuit. Now I think it's just Jabil Inc. Been trending lower for a while. They actually beat their earnings estimate, as did Smartsheet, by the way. But Jabil beat 168 versus 146. It was up 8.7% in pre-market. But let's see if we get a See if it's opened yet here. No, still not showing it. All right. And then 3 you must see. I'll give you 3 real quick. NVIDIA has been trading down for a while, very near support. So we are bouncing just like the overall market. I didn't look at NVIDIA's puts and calls. My guess is they probably had a ton of in the money puts. And so we're seeing a rebound. Look for possible reversal at some point. Maybe we get up to about the 240, 245 area. Beyond that, I would be very careful. And I don't even know if we get there. If I was long on NVIDIA, I would be taking profits as we move up. And I wouldn't worry about trying to catch the top. If you're making money on the long side in a cyclical bear market, say thank you very much and be sure to get those profits locked in because they can evaporate very quickly. It could be intraday move, or you could think you look really good going into the close. Market closes on the high, and the next day something happens. I don't know, Russia and Ukraine, or something happens here domestically, whatever. An economic report comes out, whatever. All of a sudden, Dow futures down 700, and you're holding these longs and profit gone. So be very nimble. I think cash is a good position, and just, slowly work into certain positions. And then when you make money, get the heck out or take profits. Be very careful overnight. If you're going to hold overnight, just beware. That's all I'm going to say, because when you get into a volatile market, we can see some big moves in either direction. Anyway, NVIDIA got a little bit more room to the upside. Now, one stock that has bounced pretty nicely, this would be an interesting one to take a look at in terms of Max Payne, but Solar Edge, after moving way down, many of the renewable stocks have done very well. And look at that, the save at the 20-day. This is a group right now that's actually trading pretty well. And this is a growth area. So is this a sign maybe things are turning? Possibly. But I'm not seeing it across the board. We're still seeing overall growth indexes going down more than value indexes. So I would say still the odds are to the downside. But hey, anything in the growth area that's starting to move up is going to help. And right now, this is a group that's doing pretty well. Needs to get through about 330, 332, something like that to get the next breakout. I would probably trade it in this range, 20-day moving average to the downside, and then that 332 area that I just talked about to the upside. Last one I'll mention is Molina Healthcare, MOH. I really liked the candle yesterday. I'd like to see a little bit more volume, but we might get that today. It looks like we're breaking out on Molina. So I wanted to just point that out. Today's action, we are in breakout territory. And actually, let me see where we opened, because I always like to look at this. Here, the candle body was 327.99. So we wanted to open above that. Today, we opened at 329.02. So we did open above it. That doesn't guarantee us we won't get a head fake, but I really like the prospects of Molina going higher in time based on the fact that we have gapped up above that prior high. Could we come down first, hit the 20-day? Sure. Market's volatile. Anything could happen. Option expiration week. I don't know if Molina is even heavily traded in options. Something maybe to look at. But I just wanted to point it out. Looked pretty good to me. It's in healthcare, more defensive area that does better in a cyclical bear market. So maybe we get a nice breakout here on Molina. All right, that's it for me. Let's take a quick look at the market. And I'm just, please be prepared for whipsaw today. I don't know whether we should trust this move or not. NASDAQ's been coming down since that earlier high pre-market. NASDAQ still up 1.25% right now. Dow up 1%, S&P up 1%, small caps 1%, mid caps a little bit more than that. VIX is down to 28 and change. If things turn back around to the downside in the market, you could see that VIX easily shoot back up into the upper 30s, maybe even in the 40s if things really get rough. But I'll tell you, if we get the VIX up into the upper 30s or into the 40s, and you're thinking about where should I be getting in on the long side, if you're not starting to accumulate whatever it is you want to buy, whether it's the QQQ, the spider, whether it's individual stocks, with a VIX up in the 40s, it's starting to look like the kitchen sink is being thrown in. At that point, I think it would be prudent to take a shot on the long side and start building positions. That's what I'll be looking to do anyway. All right, that is it. Appreciate everybody tuning in. I'll be back tomorrow over at Stock Charts TV for your next Trading Places Live. That will be recorded and we'll start at 9 a.m. So at 9 a.m. tomorrow, all you have to do is go over here, click on this Stock Charts TV menu item, and then you can listen into the next show. Interesting day today. Fed meeting at 2 p.m. I don't know what's going to happen. I think that it's going to be like July 4th fireworks. One last thing I'll mention now that it's March 16th is when you're in a cyclical bear market and we're talking possible recession, I think this is warning season. March 16th to the end of March, maybe even into early part of April. It would not surprise me if some big names, Apple, Microsoft, something big comes out and says, we're not going to make our numbers, or we just see things, really deteriorating a little bit, and blah, blah, blah. This is warning season. Do with it what you want. All right, that's it. Everybody have a great day. Appreciate you taking the time to join me. Happy trading.